Good afternoon, everyone. Welcome to our first quarter 2023 Market Insights webinar. Our goal here is consistent with previous webinars. We'd like to share with you our thoughts on what happened during the first quarter of the year, as well as give you some things to watch for across the different capital markets for the remainder of the year. Now, before we get started, the normal logistics items. We are happy to answer any questions that are on your mind. Please use the Q&A feature on your screen to submit questions. We have received several questions in advance. However, we do want to make the most out of your time with us this afternoon, so please do ask anything that is on your mind. Secondly, this session, like previous sessions, will be recorded and uploaded to our YouTube channel, so please feel free to watch again or to review and share with your committees. As a way of introduction, my name is Greg Leonberger. I'm the Director of Research here. I will host this afternoon's webinar. Joining me today is Jessica Naviscus to talk about the U.S. economy, James Torgerson, who will review fixed income. Our equity analysts are Catherine Hillier and Evan Frazier, respectively, who will discuss U.S. equities in that order. We'll then transition to the alternatives section of this afternoon's webinar. Chad Schaefer will discuss hedge funds. Josh Cabrera will review real assets, which consists of real estate and infrastructure. Heath McCollum will cover private equity. Last but not least, Brett Graffey will discuss private credit. So with the housekeeping items and introductions out of the way, we'll start with the U.S. economy. We like to lead off with this because it really is the backdrop to all the capital markets we're going to discuss this afternoon. So Jessica, over to you.
Thanks, Greg. So as we've been talking about over the last several quarters, inflation continues to be very central to what's going on at a macro level. The latest inflation read was March CPI that was released earlier this month. The headline number was 5% year over year. That was the lowest we've seen in 2 years. And you can see in the chart, the green line is continuing to correct off that peak of 9.1% back in June. But core inflation, which is in the blue, has started to level off the last few months, around 5.5, 5.6%. Core inflation strips out food and energy prices. Energy has been one of the main areas where we've seen a lot of pricing relief over the last 9-ish months. We should continue to see relief there until we lap that peak in oil prices in June, but that benefit is not flowing through to core. So core inflation at this point is really reflective of what's going on in services and the labor market strength, and that could continue to be a sticking point for the Fed as they think about what to do with rates for the rest of the year. So on that labor market strength, since the bounce back after COVID, we've continued to see a mismatch between the supply of and the demand for labor. So we see that in historically low unemployment rates and above average job ads in this chart, as well as job openings that are still outweighing the number of unemployed, higher quit rates, and then wage growth that is still too high to be consistent with target 2% inflation. So progress here has been slower due to a number of different structural factors. But you can see in the chart the last few months, data has been trending in the right direction. That's definitely helped support markets. And it's been a key factor in expectations that the Fed is ready to pause its rate hikes. So on those rate expectations, this chart summarizes where we've been. So the 425 basis points of hikes that we saw last year, and then the 225 basis point hikes that we have seen so far this year, and then the go forward expectations in gray. So this is based on futures pricing. This is not Marquette's opinion, but it's what the market is currently pricing in. So at the last FOMC meeting in March, Powell talked about how the committee is trying to factor in some of the unknowns stemming from the issues in the banking system. So the biggest factor there is expected tightening in credit conditions. So that's banks, especially regional banks, pulling back on lending in order to remain solvent. And that could potentially negate some of the need for higher rates from the Fed. So the decision in March was to raise 25 basis points. That was a step down from the 50 basis points they were considering pre-SVB. And then Powell alluded to one additional 25 basis point hike before pause. The market, as you can see, is taking it a step further and expecting rate cuts to start as early as this year. So expectations have actually come down a bit since we put this chart together a week ago. So the base case now is that rate cuts start at that November meeting, so a bit less aggressive than what you're seeing here, but it's still not lining up with the messaging from the Fed. So they have made it clear that they intend to maintain rates at a restrictive level until more progress is made with inflation and the labor market. So to the extent these expectations hold, it could be a risk for markets in the second half. Then just a quick chart here to emphasize that point on tightening credit conditions. So this is the Bloomberg U.S. Financial Conditions Index. So this tracks the level of financial stress in markets as well as the availability and cost of credit. So a negative reading, which you can see the index fell into negative territory in March, indicates restrictive levels. So that's in line with what the Fed expected, and something to keep a close eye on as the year progresses. So it'll impact what the Fed does, just general economic growth, as well as any individual companies that are trying to finance or refinance debt. Then just a few more specific slides on the bank failure. So SVB and Signature were big headlines mid-March. It was the second largest bank failure in U.S. history, very quickly followed by the third largest bank failure in U.S. history. That's definitely true, but the context is really important, especially as it relates to thinking through the risk of contagion. So those two banks, you can see on this chart, represented a pretty small portion of U.S. bank assets. So combined, it was less than 2%. And that's compared to some of the big banks there. So JP Morgan, the largest in the country, is 15% of assets. Bank of America at 11, and then Citi and Wells are at 8. So just the pure size of those and the implications for diversification put those banks in a really different position. Then bank borrowing. This helps us kind of assess where we are kind of post SVB. So it's been more than a month since the headlines. The news cycle has really died down. Equity markets have clearly moved on. And besides some of the credit tightening that we talked about, there have not been a lot of broad implications. So part of that was due to the Fed, the Treasury, and the FDIC guaranteeing deposits, as well as increasing lending facilities for banks. So these two charts combined represent total bank borrowing. So the discount window lending on the left, you can see spiked even above above GFC levels, hit a peak of about 153 billion mid-March. That's more than halved. A lot of that did flow to the Bank Term Funding Program, which offers more favorable terms to banks. But on a combined basis, lending is down from the peak in mid-March, which just speaks to less pressure on banks to meet deposit withdrawals, which has really always been the main issue. It was always a crisis of confidence as opposed to any real credit issues. And the same point is made on this slide. So this looks at deposits of small and large U.S. banks. So after the initial turmoil, we saw outflows from small banks. Scale is important here. It looks like a pretty big dip. It was about 4% of deposits. So not huge, but not immaterial, clearly reflecting concerns about the safety of deposits. Initially, we saw some of that move to large banks, though deposits have ticked down there as well, just reflective of higher yielding opportunities elsewhere. But the main takeaway is that the outflow from small banks had stopped by the end of the month. So the last week in March, deposits were flat, and the first week in April, they actually tipped up. So again, just speaking to less fear around the banking system and potentially one less headwind for the economy.
Thanks, Jessica. And some of the themes you talked about have been common themes over the course of this series, probably for the last year and a half, maybe even 2 years, about inflation and interest rates and how one informs the other. And certainly we're seeing some favorable developments in terms of inflation starting to fall, and then that really informs the Fed's decisions on how much they're really going to hike rates from this point forward. So I think that those in all should be a win for the economy. You touched upon credit availability. I know some of our other analysts are going to talk about that as well, but that could be a headwind for the economy. And what we didn't talk about, we didn't use the R word at all, recession. And we certainly can't discount the possibility of that as the rest of the year goes on, of course. It'll really be driven by these themes here and really how much they assist the economy or prevent the economy from growing at a positive rate. So Jessica, as always, thank you so much for the comments. Let's get in now to the traditional asset classes. We'll start with fixed income. Anyone who remembers some of the comments we made at the preview edition of this series back in January will remember that we felt really good about fixed income in the probability of fixed income delivering positive returns for calendar year 2023. The first quarter is off to a good start in that regard, but it was a little bit of a bumpy road to get there. So James, talk us through what you saw, how we got to these positive returns, and that we were watching for the rest of the year.
Yeah, thanks, Greg. And as you mentioned, fixed income did see positive performance in the first quarter. So continued a strong trend from the fourth quarter into the first quarter. All the sectors here in this chart had positive performance so far year to date in the first quarter. However, how we got there was a bit of a bumpy ride. So January was a Goldilocks scenario. A Goldilocks scenario is where rates were down and spreads were tighter, so performance was quite good in January. However, come February, that performance reversed. As rates went back up, spreads widened out as inflation fears and further Fed hiking fears resurfaced. However, banking turmoil in March sent spreads wider, and ultimately, though, performance was still positive as rates fell on economic fears and expectations of Fed pausing or even reversing course on the back of bank turmoil. So let's take a look at the yield curve. While rates did finish the quarter lower, the yield curve still remains inverted. The spread between the 2-year Treasury and the 10-year Treasury is 58 basis points. So the 2-year Treasury is 58 basis points higher than the 10-year Treasury. The inversion of the yield curve has been historically a recession signal, and this has been inverted since June or mid-2022. Front-end or shorter-dated Treasuries are more sensitive to Fed interest rate policy. So if the Fed does continue on a restrictive policy path, which might not be the case anymore, the curve will most likely remain inverted. Now let's take a look at spreads and yields in fixed income. So ag and IG spreads were slightly wider quarter over quarter, while below investment grade spreads tightened in quite a bit. Core spreads and IG spreads were relatively flat, and they're sitting about near-term or sitting at long-term averages right now. So spreads were volatile in the quarter, but they're not at recessionary levels, and spread valuations are probably just fair and maybe slightly attractive. Yields now let's take a look at yields. Yields fell across all sectors in fixed income in the first quarter. These remain well above long-term averages and are still at attractive levels moving forward. These will provide an income cushion for fixed income investors if economic data continues to deteriorate. Now let's take a more granular look at spreads. So U.S. IG spreads, while they did widen in March on the back of the banking turmoil, did come back in or sitting around the 10-year average. A more interesting look is when you take a look at high yield spreads. So during that turmoil mentioned in March, these widened out significantly and were much above the 10-year average. However, these retraced quickly as those banking fears dissipated. So spreads are above average slightly on a 10-year basis, but still not overly attractive. A weakening economy could really send these spreads wider. So now let's take a look at an interesting trend in fixed income of new issuance. So as interest rates have increased, these have continued to weigh on fixed income new issuance activity. As you can see, 2022 saw a significant slowdown in fixed income new issuance, particularly in the below investment grade space. There was record low issuance in the bank loan space and high yield bonds. This is a trend that has continued so far into 2023. This higher interest rate environment has made financing costs increase for companies. And as higher rates weigh on these balance sheets and financing costs of companies go up, the companies with these weaker balance sheets could start to see some stress. Now, this is an interesting chart. As we all know, 2022 was a terrible year for fixed income performance. It was an interest rate driven event. However, there was a positive to come out of that event. Income is back in fixed income and yields are high again. So while the continued fears of rate increases have abated slightly, moving forward, further interest rate increases will have a diminished impact on fixed income total returns. So using the yield of the aggregate as the proxy here, it would take 70 basis points of further interest rate increases for there to be a break even to negative performance in fixed income. So as I'd already mentioned, this added cushion of income will provide balance for fixed income investors and for total return in their portfolios in the events of continued interest rate hikes or a deterioration in market fundamentals towards a recession. So talk about some opportunities and risk here in fixed income. You know, as we've mentioned a bunch before, and you've probably heard us say multiple times, bonds are back. You know, after years of ultra low interest rates, bonds are finally offering attractive levels of income and yield again. They're back to their income generating purpose in a portfolio. All-in yields are above long-term averages and are attractive on a go-forward basis. And as I've already mentioned, that income cushion is back in case of spread widening or deterioration in fundamentals. Another tailwind for fixed income is, as you know, Jessica already touched on a bit with the pricing of interest rate hikes for the rest of the year. The Fed hiking cycle is likely coming to an end. After only hiking 25 basis points at the last meeting, interest rate cuts are now being priced in for the end of the year. So this is positive for fixed income because you'll see lower rate volatility, and as rates fall, this could possibly be a tailwind for fixed income returns. However, there are risks, as there always are. An economic downturn could really send spreads wider. And the attractive credit fluctuated throughout 2022, and even throughout the quarter, they were very volatile, but finished, as I've mentioned before, in line with long-term averages. Right now, they're nowhere near recessionary levels. However, if there is a bear market, bad data comes in, spreads could widen significantly from here, which would be a negative for fixed income performance. And then an interesting trend that, or maybe not interesting, but a trend we have been seeing lately in fixed income is the weakening of fundamentals in below investment grade companies. So it's something we've talked about before, that leverage credit balance sheets, particularly in the high yield space, have been fairly resilient. However, lately there have been signs of deterioration. There's been an increase in leverage coming off near-term lows. There's been declining quarterly revenues as some of these companies have not been able to pass through inflation costs anymore to consumers. And rating downgrades are now outpacing rating upgrades. So for example, in the bank loan space, there have been 11 consecutive months of downgrades outpacing upgrades in the space. And in the high yield market, there have been 5 consecutive months of downgrades outpacing upgrades. And as issuers need to refinance these higher interest rates as well, interest coverage will go down, increasing costs for companies and possibly weighing in their balance sheets, which ultimately could lead to more defaults.
Thanks, James. And the higher rates on the whole are a win for fixed income. I think the slide prior to this one is really important, reinforcing the notion that there's this cushion now that if you see further price drag, the return component is starting at such a higher point now because of the yield environment that should offset the price drag. But again, keeping an eye on revenues and revenue compression, margin compression as a result of higher interest rates is something that will not only affect fixed income, but will also affect equities. And as we transition to the equity portion of the discussion, our guidance to clients really going into the year was to expect a volatile first half of the year, and not to say the second half of the year won't be volatile, but there should be a little bit more clarity, which should provide some more direction for U.S. equities. But after the first quarter, it seems like U.S. equities liked what they saw in terms of outlook because of the positive returns, but I know it's not quite that simple. So Catherine, take us through what drove markets in the first quarter, and then what's your eye on for the remainder of the year?
Yeah, thanks, Greg.
Yep.
It was definitely an interesting quarter. With the exception of small cap value, major domestic equity indices were positive in the first quarter. Like many quarters recently, however, this was not without volatility. In January, markets generated strong returns in a risk-on rally, but this was offset in February by concerns over higher for longer interest rates in the wake of persistent inflation. Then, in March, further volatility as the banking crisis unfolded. This was particularly painful for small cap equities, with the Russell 2000 Value Index declining over 7% in the month. Large caps fared much better, with the Russell 1000 Growth Index rising almost 7%. We'll discuss this a bit further in a few slides. So from a sector perspective, the more traditional growth sectors of information technology, communication services, and consumer discretionary led in the first quarter. The chart here shows the performance for the S&P 500, but this trend largely held true across the market cap spectrum. And then diving a bit deeper into the sector dynamics, on this slide, you see sector performance in 2022 is compared to the first quarter of 2023. As we've discussed on previous webinars, in 2022, energy was the only significant contributor to performance of the S&P 500, while growth-oriented sectors composed of the long-duration growth stocks that struggled in the wake of the fast rate hiking cycle. So to begin 2023, this dynamic largely reversed. The sectors that detracted in 2022 were the only sectors to outpace the S&P 500 in the first quarter of 2023, while the energy, financials, and typically more defensive healthcare and utility sectors all underperformed the market. So given this sector leadership in the first quarter, the underlying factor drivers likely don't come as a surprise. As we see here, quality and growth led, again reversing the trends that we're seeing in 2022. So what happened in the first quarter to lead to such a reversal in trends? We've touched on it already quite a bit, but in March, the regional banking crisis contributed to this shift, as the financial sector was the worst performing sector. Shown here, large cap indices underperformed within regional banks, as these indices house those larger market cap banks that collapsed, namely Silicon Valley and Signature Bank, as we've discussed. The Russell 2000 was also impacted, though, as smaller regional banks did sell off in tandem, regardless of the strength of the bank or the makeup of the deposit base. As we can see, the Russell 2000 holds a much larger weight to the regional banking industry at almost 7%, which led to a more pronounced impact on returns relative to its larger counterparts. So now looking at market leadership over the past year, and as we have discussed, value meaningfully outperformed in 2022. But conversely, to start the year in 2023, a risk-on rally saw small caps lead or at least keep pace across the style spectrum leading up to the banking crisis that unfolded on March 8th, while growth also outperformed value during this time. In the final weeks of the quarter after the banking crisis unfolded, growth held onto its leadership and investors sought the perceived safety of large caps. The first quarter actually contained one of the worst weeks for the Russell 2000 index on record when it fell 8% amid this crisis, contributing to the notable underperformance of small caps relative to the larger cap peers. So diving a bit deeper into the leadership of large cap growth equities, the New York Stock Exchange FANG Plus Index, which provides exposure to 10 large cap technology stocks, including Apple, Microsoft, Meta, Amazon, Netflix. It outperformed the S&P 500, actually driving the performance of the index, especially Apple and Microsoft, which contributed 36% of returns during the first quarter. These 10 companies also comprise a significant portion of the weight in the S&P 500, so the market cap weighted index notably outperformed its equally weighted counterpart, given this narrow sector leadership that we saw. This narrow leadership can also be a headwind for active managers, and we saw this during the first quarter as large cap managers underperformed because they typically hold underweights to those larger mega cap companies. So with these dynamics at play, what happened to valuations during the quarter? Shown here, we see growth equities are trading at a premium to their value counterparts, while large cap growth equities are trading at the high end of their historical ranges. Small caps across the style spectrum, though, continue to look relatively attractive. So the risks and opportunities moving forward still lean a bit more to the risk side, given the uncertain macro environment that has strengthened the case for a recession later in the year amid the banking crisis, OPEC production cuts, and the persistent inflation that we've seen. This is compounded by the expectation that markets will see year-over-year decline in earnings for the first quarter, as well as the geopolitical strife that doesn't seem to want to abate in Europe and Asia. Monetary policy uncertainty may also throw a wrench in the mix if the expected rate cuts that we've talked about earlier in the webinar don't come through as expected later in the year. Not all is negative, though, as small cap valuations, as we saw on the last slide, remain attractive, and the expectations for a Fed pause in the second quarter may prove to be supportive for equities down the road.
Thanks, Catherine. As always, a lot to watch for out of equity markets, a lot of moving pieces, and every quarter there's going to be volatility. It's just a matter of where it comes from. So that's the story on the U.S. side of things. Let's kind of go overseas, if you will, and talk about non-U.S. equities. Evan, why don't you take us through non-U.S. and tell us kind of what happened and the parallels between U.S. and then what was different versus U.S.
Sure thing. Yep. Thanks, Greg. So yeah, similar to domestic equities, international stocks saw strong performance in the first quarter, most of which was notched in January and March. So the MSCI EFA index returned about 8.5% in dollar terms during the period. The EM benchmark was up closer to 4%. And you can see if you look at the difference between local and dollar return here, both indices saw a slight currency benefit for the quarter, which we'll detail in a coming slide. So what led this quarter from a sector perspective? Again, it's similar to what happened on the U.S. side. Growth-oriented sectors that were hit the hardest in 2022, like IT, consumer discretionary, communication services, actually saw the strongest performance in 1Q. These sectors returned upwards of 10% for the period. I should mention that this chart is looking at the MSCI ACWI ex-U.S. index, which tracks both developed and emerging markets. On the flip side, the sectors that led last year, so think energy, utilities, real estate, those were some of the worst performing spaces of the non-U.S. market. So I would say a bit of a reversion to the mean quarter as it relates to sector performance. I guess the last thing I'll mention on this slide is the financial space, which is the largest segment of the ACWI ex-U.S. Index. Obviously, an interesting quarter for financials, both at home and abroad. You can see that in the poor March figure for that space. However, the sector actually ended the quarter slightly positive on the non-U.S. side, and we can dig into that a little deeper on the next slide. So as Catherine and Jessica detailed earlier, we had a couple of domestic regional bank failures last quarter and several others that saw their share prices severely impacted as a result of that turmoil within the space. We also saw the acquisition of Credit Suisse by UBS in order to save off its collapse. So how did that impact the performance of non-U.S. financials during the quarter? Well, interestingly enough, we didn't see the same kind of sell-offs across the financial space within international markets that we saw in the U.S., and there are a couple of reasons for this. So, for instance, a lot of non-U.S. banks have seen much stronger profitability and liquidity coverage ratios than their non-U.S. or than their U.S. counterparts of late. Deposit growth has been stronger in places like Europe versus the U.S. in the last year or two. So, we don't want to prematurely declare that this banking crisis has been contained, but it's been nice to see some insulation on the part of international markets, at least to this point. So on factor performance, I think the mean reversion story that I mentioned earlier still applies here. So growth and quality were two very challenged styles last year, given concerns about the macro, higher interest rates, et cetera. However, these two factors saw a nice rebound, as you can see here in the first quarter. And on the flip side, cheaper, lower volatility stocks, they were still positive for the quarter, but certainly didn't exhibit the same kind of factor leadership they displayed in 2022. So no non-U.S. equity presentation would be complete without a slide on China. As many of you are no doubt aware, the Chinese government rolled back a lot of its COVID-related restrictions late last year, and that has helped their economy bounce back pretty nicely in recent months. So as you can see here, PMIs are higher. China's non-manufacturing PMI actually hit a decade high last month. And inflation has been relatively low in China, meaning their central bank has been able to keep monetary conditions relatively loose. And all of that has been very conducive to positive performance for Chinese equities of late, with the country posting a return of just under 5% during the first quarter. So I mentioned currencies briefly earlier. Both EFA and EM currencies were positive slightly for the quarter. This is sort of a continuation of momentum from the fourth quarter of last year that also saw strengthening of international currencies. I would say a couple of reasons for this. Number one, you've sort of had a convergence of interest rate policies across major economies. So the ECB, Bank of England, they've all signaled that they're going to keep hiking. Japan may be loosening its yield curve control policy here in the near term. All of this while the Fed appears to be nearing the end of its rate hiking cycle. You've also seen an uptick in what some have referred to as de-dollarization, or a shift away from the dollar in terms of usage in global trade. So, for example, we've seen China using the yuan in its commodity trading to a certain extent. Certain Latin American countries have talked about forming currency unions. I don't think there's a huge risk of the dollar losing its reserve currency status anytime soon, but this type of activity, should it continue, could exert downward pressure on the dollar in the near future. So let's look ahead at some opportunities for non-U.S. equities, as well as some risks that are currently faced by the space. So as far as opportunities go, we talked about currencies. The dollar remains well above trend, and the reasons we cited for sort of strengthening of international currencies may persist into the near future. We talked about the China reopening, a continuation of accommodative monetary policy, along with sort of stabilization in their property sector, which is what we've seen over the last few months, could serve as tailwinds for that space going forward. One thing we didn't detail already is the valuation landscape. So non-U.S. equities continue to exhibit very attractive valuations across a variety of different metrics. The EFA trades at about 12.5 times forward earnings. EM and EFA small cap indices are closer to 10.5, and those are all in the cheapest third in terms of history for each of those indices, and much lower than the S&P, for example, which trades at about 17 times. One thing that's not on here, but probably should be, is the fact that EFA company earnings have been surprisingly resilient in recent time as well. So definitely, I would say a bit to be optimistic about when it comes to the risks. We discussed the turmoil faced by some domestic banks of late, and while, like I said, contagion doesn't appear to be a problem at this point, those issues will almost certainly result in tighter lending standards, which could slow growth. Inflation is still hot in places like the Euro area, and manufacturing activity has slowed there lately as well. And then the geopolitical issues that Catherine mentioned that just won't seem to go away. So 1Q saw the spy balloon controversy, the Russia-Ukraine conflict drags on. We're now over a year into that conflict. So, there are certainly some potential landmines and areas of concern, along with those opportunities that pose challenges to investors as we head into the summer. And with that, Greg, I'll turn it back over to you.
Thanks, Evan. I think that the two prior slides are really important to reiterate, and you touched on it here, but just to repeat one more time, the currency dynamic and a kind of a normalization of the dollar versus other foreign currencies should be a help to non-U.S. equities, a tailwind for returns when it was such a headwind last year. And then China reopening, we can't ignore the impact of the Chinese economy and Chinese demand upon the rest of the world and how that could also be a tailwind for non-U.S. equities. So, Evan, thanks for covering that. And then that really concludes the traditional section of this afternoon's webinar. We'll move on now to the alternatives. We'll kick it off with hedge funds. Chad, hedge funds definitely have a better story to tell more recently than they did, let's say a couple of years ago. Take us through what you saw in the first quarter, as well as kind of what you see for the rest of the year in terms of not only return expectations, but perhaps opportunities for some types of hedge fund strategies.
Sure. Thanks, Greg. So hedge funds were broadly positive in Q1, I'd say, albeit relatively muted compared to broader equity gains. The HFRI composite was up about 1.2% for the quarter, while equity hedge funds were actually the best performing sub-strategy, up 3.4% or roughly 45% of the S&P 500 move. Notably, the only two sub-strategies that posted declines in the quarter were macro and merger arb. Both of those were impacted by the stress seen in regional banks and the corresponding impact that had on rates. Now, specifically for macro, which led all hedge fund sub-strategies in 2022, many of these managers were positioned short in rates, driven by ongoing bearish views of inflation, the Fed rate hiking cycle. Now, the sharp reversal in rates, primarily on the short end of the curve, caught many macro strategies offsides, and the themes that drove 2022 performance quickly reversed for the quarter. Now, turning to equity long short and starting with leverage, we've seen gross and net exposures rebound from multi-year lows at the end of the year. Equity markets rallied aggressively in January, and we saw gross exposures increase by about 15% or so for the month, with managers adding to defensive sectors like healthcare, generally rotating out of small cap and into large. Now, net exposure by comparison steadily ticked up over the quarter, ending at about 48% net, and this is the highest exposure we've seen in over a year. Now, from a performance perspective, the long-short spread, or the difference between long and short positions, was positive in March, but really negative overall for the quarter. Crowded longs actually did pretty well, outperforming the S&P 500 for the quarter, but they've lagged longs pretty materially for the quarter, and you can see that here. Now, looking one step deeper, it's interesting that style factors have been primarily driving active returns so far this year, which weighed on long alpha in March, but was actually a positive contributor for the short side. Overall, security selection for the quarter was pretty muted, both on the long and the short side. Now, shifting gears a little bit here and talking about the current environment and the opportunity set for hedge funds, this next chart here shows two measures of implied volatility. First, the blue line, this is the VIX index, which measures implied equity market volatility, while the move line, the orange index, measures implied volatility for bonds. So what's interesting here is how bond volatility has really decoupled from equities over the past year or so. And it's most notable in March, where we saw the stresses from regional banks dramatically shift expectations for their Fed rate path. Now, notably, this happened on the short end of the curve, as I mentioned before about short rates, short positioning and rates impacting macro managers. The two-year Treasury saw the largest one-day move in over 35 years. So as you can imagine, it's created some dispersion and differences across asset classes. At the same time, concerns seen in the bond markets basically were absent from equities and credit markets, at least at the broader index level. You can see that here by the lack of movement in the VIX. For hedge funds, though, increased volatility and especially diverging reactions across asset classes tends to create wider dispersion, and that's generally an improvement in the opportunity set for skilled managers to generate alpha. Now, I mentioned credit and how the pickup in volatility we saw in bonds was largely absent from these markets. You can see that here on this next slide. The solid green line reflects the yield to worst spreads for the U.S. high yield market. And in Q1, credit spreads actually moved a little bit tighter from the end of the year and are hovering around long-term averages. Now, my colleague Jessica talked about the financial conditions index. This is again shown here, but just to reiterate, this measures the overall financial stress of markets and also helps to assess both the availability and the cost of credit. So to the extent financial conditions worsen, and namely if we see a sustained pullback in bank lending volumes, this has the potential to create significant challenges for corporate issuers. Now, it's notable again that high yield spreads remain relatively tight here, so it's not an indication that there's widespread stress present in current credit markets. But to the extent stress does form, and James talked about some of the weakening fundamentals in high yield, This improves the opportunity set for credit, event-driven, and distressed managers, and should likely expand significantly from here. Now, for now, funds with flexible capital structures remain relatively conservative in positioning, and so they're set up pretty well to take advantage with opportunities forming on the horizon. So just to wrap up the opportunity set here, let's take a look at M&A. M&A volumes declined year over year in Q1, and that's on the back of a slowdown we saw in 2022 as well. Now, there's no doubt this was driven by the macro backdrop, increased uncertainty around the economy, the level and path of interest rates, the broader implications of restrictive Fed policy, potential for a recession. All of these things contribute to a slowdown. Now, for the first quarter, volumes declined 36% year over year, and that's on pace for the slowest year of M&A activity since 2013. While deal activity has slowed, it's notable that spreads have widened for announced deals, and you can see that on this chart with the black line, partially reflecting the rise in interest rates, which is the orange line, but also a reflection of ongoing regulatory risk in M&A. Now, wider spreads portend better return expectations, but given the regulatory risk, I'd say managers need to carefully pick their spots along the way. And I'd say in general, most are holding either dry powder or just have reduced exposure to merge or arb at the moment. Now, that being said, I'd say it's unlikely M&A will completely freeze up for the full year in 2023. There are a number of industries that need to fund M&A growth, and a number of prominent activists have launched proxy fights, which I think will likely lead to more deals announced, though I think overall volumes could probably remain muted for some time at this point. So with that, I'll pause there and turn it back to you, Greg.
Thanks, Chad. I know that the private markets team will touch upon deal activity and what that looked like in that space as well. So that's definitely one theme which we're watching. And the other one, which you mentioned, is the opportunity set for distressed managers and how that's been a fairly compressed space for the last couple of years. The economy, COVID notwithstanding, has been in pretty good shape. But as the additional headwinds start to manifest themselves more across the growth landscape, I think we might see a few more opportunities for those types of managers to make some hay. So, anyways, thanks a lot for the hedge fund coverage. Let's now move to real assets, and there's both real estate and infrastructure included in this conversation. And one of the themes which we've talked about a lot over the course of this webinar and previous ones is higher rates and what that has meant for the various asset classes. And we're really starting to see that really present itself with real estate returns as well. So Josh, I know you're going to touch upon that, but more broadly too, kind of tell us what you're seeing, and not only in the trailing quarter, but also for the rest of the year.
Thanks, Greg. Let's start off with performance here. Commercial real estate continued its decline in the fourth quarter. The Odyssey benchmark of open-end real estate managers was down another 5%, with continued write-downs in office and slowing rent growth in industrial and multifamily, driving the majority of the performance attribution. All 26 Odyssey funds reported negative appreciation, with downward pressure on pricing expected to persist through the first half of this year. In addition, 8 funds reported income returns well below 70 basis points, a reflection of the rising costs of floating rate debt and lower in-place rents in many industrial and office portfolios. Going forward, prelim first quarter returns are coming in at negative 3.16, likely an indication of the lack of price discovery and the impact of dispersion between property sectors, markets, asset quality, and leverage across fund strategies. That said, long-term fundamentals across industrial, multifamily, and select niche sectors in markets with dynamic job growth remain strong. Let's pivot here to sales volume trends. The bid-ask spread is currently the widest it's been over the last year for most marketed sectors, especially for gateway office properties. The pace of transactions continued to slow materially in the first quarter, down over 60% from 2022 levels. The availability of debt financing has taken a step back, given the recent bank failures and persistent market volatility. Given the pressure on balance sheet and capital requirements, it's also likely to result in cutbacks in regional bank loans. Broader concerns about a recession have negatively impacted portfolio underwriting, fundraising, and transaction volumes. Overall, the real estate market is now in an adjustment period that will take more time to play out. Let's shift gears here to vacancy and supply side metrics. Given the resiliency of the U.S. labor market and consumer spending, the underlying economy is still quite strong. As capital market volatility continues to pressure valuations and income returns, vacancy trends are still promising. Industrial, multifamily, and retail vacancies are well below their pre-GFC levels. Office is the only sector showing significant weakness, where vacancies and subleases are now roughly 250 basis points above their pre-GFC levels. Continued rate hikes and ongoing inflation may cause a pullback in demand within industrial and multifamily, where we are seeing elevated construction starts. Higher interest rates have caused developers to pull back by more than 40% over the last 12 months. This trend signals that the number of completed construction projects will moderate significantly by the spring of 2024. However, we expect any declines in new supply will be met with improving tenant demand. Now let's move on to infrastructure. Infrastructure performance continued to regress in the third quarter, declining by another 80 basis points within the broad private market index. The instability of inflation, interest rates, GDP growth, and valuations over the past year have made infrastructure assets more susceptible to the fluctuation to beta headwinds. However, supported legislation in the form of the Biden bill and the Inflation Reduction Act should present significant upside for infrastructure and transform the U.S. environmental policy landscape. As global decarbonization efforts will require a $100 trillion investment over the next 3 decades, these regulatory measures are expected to have a positive impact on the energy transition in line with future infrastructure demand. Finishing up here with infrastructure as an inflation offset. As shown by the bar chart that highlights the relative performance of globally listed infrastructure at different levels of inflation over the past 17 years, overall infrastructure tends to outperform the public equity index in periods of higher inflation. Infrastructure assets still prove to be a hedge against persistent inflation, given the underlying nature of the cash flows. Structurally, most assets have an explicit link to inflation through regulation, concession agreements, and contracts, and as a result can pass through higher supplier and debt costs to end consumers. With those highlights, Greg, I will kick it back to you.
Thanks, Josh. I know we've said it kind of ad nauseum in this webinar series, but the merit of infrastructure really is that link to inflation, the ability to hedge against inflation. And then with real estate's a little bit of a bumpy ride at this point, to be completely honest. That the price appreciation is really price depreciation, and unfortunately, we're probably going to see a few more quarters of that. And funds that are over allocated to office will probably see the roughest ride. But it's a matter at this point now of how much our funds are going to be able to pay out from an income perspective to offset the price depreciation. So again, we think real estate's a great long-term play, but it's going to be a little bit more of a bumpy ride for the remainder of 2023. So that's the outlook for real assets, both real estate and infrastructure. Let's move on now to private markets. We have private equity and private credit. Haley, I'll let you lead it off with private equity, then we'll pass it to Brett for the credit side of the conversation.
Great, thanks, Greg. So most of you know, but private equity is reported on a lag basis. So the chart here shows 3Q performance. We're expected to get 4Q performance in the next couple of weeks. So you can see as of 3Q, private markets have outperformed public markets on a 1, 3, 5, and 10-year basis. So this is subject to change, and we're not going to know until the final numbers come in, but it's looking like private equity performance for the fourth quarter is going to come in close to flat, and venture capital is going to be slightly down. So valuations have been sticky. Companies are focused on preserving cash, so they don't need to raise another round of capital. Only the highest quality of deals are getting done. This is what's causing performance to remain slightly flat. So for private equity funds to avoid further markdown, it's going to require the Fed to at least pause rate hikes, ideally begin to ease, which is going to drive liquidity and credit conditions. So you can see on this slide, there's abundance of dry powder in the market. So the light beige section shows that a lot of this dry powder is concentrated in the upper end of the market. So this dry powder is going to be what's going to drive deal activity in the private markets. So as the dry powder needs to be deployed, it's going to create great exit opportunities for middle market companies because those larger private equity backed companies are going to look to be buying middle market companies. I think this slide is important to show that historically in market turndowns, private equity has had a quicker, less severe recovery. So you can see the graph on the left, the dot-com crisis, and on the right is the global financial crisis. Private equity didn't suffer as much of a pullback in performance. But every downturn is different, and there's no guarantee that this downturn in the market is going to be the same as these two scenarios. Shifting gears to the secondary market. So I think the theme with the secondary market is it continues to evolve. I think when people heard the secondary market, they would think this was a place where distressed LPs were selling low quality assets that they did not want on their reports anymore. Now the secondary market has developed into including high quality assets and GP-led transactions. You can see the chart on the right, given the denominator effect and liquidity concerns, discounts within private markets have become very attractive. So we think the opportunity set within the secondary market is an attractive area within private markets. Then shifting to venture capital. So some will say that the current correction in venture capital is what the industry needs because valuations skyrocketed in 2021. So the light blue bar on the top is venture growth, and that's defined as any financings that are Series E or later, or any VC company that's at least 7 years old or has at least 6 VC rounds. Long way of saying this is later stage venture capital. So you can see that's the area where valuations were the highest and took the deepest dive. So growth and late stage startups are struggling because there's a lack of exit opportunities with the IPO market being closed. Earlier stage venture is more insulated from market headwinds and has benefited from the record levels of dry powder. There's more opportunity of exit rather than just IPO. So from a valuation perspective, we think that early stage venture is going to be less impacted by the broader economy and public markets.
Thanks, Haley. I just want to touch on that secondary slide that you mentioned just a minute ago. And it's really an important reminder for all of our listeners that I think perhaps historically the secondary market has had negative connotations of funds just trying to dump these investments. But as the denominator effect has really impacted portfolios, and of course that means the rise of overall presence of illiquid assets in portfolios because of the large drop in public markets has put some companies or put some funds in this position. And it's certainly a more attractive and supportive environment today in the secondary market than perhaps it may have been in previous market cycles. So that's the private equity side of things. And of course, what drives private equity is availability of credit. Private credit has certainly benefited from the kind of the increased transaction level across private equity, as well as the privatization trend we've seen across markets. So Brett, talk a little bit, more recently about what we've seen in private credit, as well as kind of the bigger picture and longer term opportunity.
Thanks, Greg. And absolutely, there's a close correlation, a close tie between private credit and what Haley said in regards to private equity. So once again, reporting on a lag basis, private credit finished up 1% for the third quarter in 2022, exceeding all public fixed income and equity indices, actually except for the Credit Suisse Levered Loan Index, which had trailed by about 20 points. Similarly, over the 1, 3, 5, and 10-year periods, private credit has bested all public fixed income and equity indices except for the Dow Jones Industrial Average and the S&P 500. Overall, the return and yield premium achieved by investing in private credit remains a return driver and risk mitigant for the asset class. In taking a look at overall deal activity, which Haley touched on, but for the private credit side, private credit continues to take overall market share from the banks. Remembering that every leveraged buyout typically is financed with about 40 to 50% debt and supported by about 50 to 60% equity contributions from the purchaser. Private debt lenders continue to be the financiers of choice for LBOs. This continues to be a long-term trend driven by the structure flexibility and the ability or guarantee to close that private debt lenders provide to a buyer. In 2021 and 2022, inflation emerged as a top threat to investor portfolios, and private credit offers protections against that inflation. The floating rate nature of these loans means that investors can be protected if inflation causes short-term interest rates to rise. SOFR, which is the floating rate component of private credit, has risen by nearly 425 basis points over the past year. Additionally, credit spreads widen on average about 100 to 150 basis points, providing private credit loans today with an all-in yield of about 10%, continuing to provide investors with strong income and a hedge against inflation. Floating rate loans are likely to outperform fixed rate bond allocations in a rising rate environment like we've experienced the past year. And looking at something more forward-looking, such as recovery rates, reviewing recovery rates for debt going back to 1987, loans to middle market companies have on average higher recovery rates relative to loans made to large cap companies. On average, those recovery rates are about 15% higher across all forms of bank debt for middle market companies. This is a beneficial attribute which continues to help protect investors' principal and has aided in demand for the asset class in a potential recessionary market when defaults and bankruptcies tend to spike. And with that, Greg, I'll pass it back to you.
Thanks, Brad. And this slide right here is an important one to share with all of our listeners, because James talked about in the fixed income section. It was alluded to in a roundabout way in the hedge fund section as well, that defaults are likely to rise. Now, they've been at such record lows, defaults rising from almost 0% basis to an absolute level of zero. In and of itself, it shouldn't be wholly damaging to the economy, but will also present opportunities and also start to separate different managers into different types of strategies. So a dynamic we will be monitoring over the coming quarters. So we have a little less than 10 minutes at this point. We wanted to make sure we allowed time for questions to be submitted. We have some in advance. We're going to go through these. As we go through these, or as you digest any of the comments that you heard from many of our analysts, please feel free to ask any other questions. We'll get through as many as we can before the top of the hour. But just to kick this off, because again, some people sent these in advance, is given the Fed's hawkish tone in the recent quarters of cap rate expansion, how are real estate managers going to source returns going forward? Josh, this should go to you.
That's a great question, Greg. Despite a challenging fundraising environment, sector-focused and opportunistic managers are well positioned to drive accretive returns with targeted deal flow, light renovations, and asset repositioning. Real estate investors have the opportunity to enter distressed debt and secondary market opportunities at unlevered discounted price points. NOI growth, although slowing, remains positive within industrial, residential, and even a growing number of retail assets. While market rent growth has decelerated in industrial, it remains well above historic norms in some major distribution hubs, such as Southern California, Northern New Jersey, and Southern Florida.
Next question. Did active managers in the non-U.S. equity space see rebound in 1Q after a tough 2022? Evan, I think this has your name on it.
Yeah, so definitely tough year last year for active managers. I think about a third of managers outperformed their respective indices in 2022, so definitely tough. A lot of that was due to the quality factor being out of favor, which we touched on earlier. A lot of active managers, probably unsurprisingly, gear heavily toward that factor. This year, it's been a little different. So quality, like we talked about earlier, is back in favor. There's obviously a cost of capital in the market now. Those are typically favorable conditions for active managers. And indeed, most managers did see positive relative performance in the first quarter across all major indices within the non-U.S. market. So yeah.
Chad, what should hedge fund investors expect from macro going forward this year after the reversal in March?
Yeah, I talked about macro underperforming in March, really giving back gains they had in January and February. And this is after, again, a strong 2022 where the macro index itself was up 9%, but there were many managers in the space up 20, 30+%. Despite tough relative performance for the month, I think a lot of the key macro factors that propelled returns in 2022 are still kind of there in the background going forward. Most prevalent being inflation expectations, path of interest rates, debate around the start or the severity or how long it's going to last of a recession. But in general, I think when there's divergence in monetary policy, there's heightened volatility in this case in bond markets, but overall you kind of see it spike in different areas over time. Concerns on inflation, so on and so forth. I think this is generally a positive backdrop for macro strategies to add value and outperform. So I kind of expect those trends to drive performance through 2023 as a whole. And now that being said, I think there's always a risk of strong trends and themes reversing course. Saw this in March, of course. And the underlying drivers of policy can change as well. So there's always the risk of potential drawdowns and pullbacks. But overall, I think the opportunity set's still positive for macro. But there'll be plenty of bumps in the road, and I think it'll be a bit choppy for the rest of the year, just given all the major headlines that are playing out.
Thanks, Chad. James, is the lack of new issuance in fixed income a cause for concern?
So I would say no, it no longer is as big as cause for concern. The lack of new issuance last year was primarily driven by rate volatility that we saw in the fixed income market. So as investors and issuers, responded to the drastic increase in interest rates, the volatility caused companies to not want to issue as much fixed income paper. So as this rate volatility starts to ease, you should start to see more paper coming into the market. You should start to see continued growth in the new issuance, even though it's been slow so far this year. As we get more clarity on the Fed's ultimate path, you should start to see more issuance there. While it was a concern last year because of this volatility and trying to source new opportunities, it actually creates a stronger technical bid if you look at something like the high yield market, as the lack of issuance and the amount of rising stars in that market has caused a lot of money chasing a little bit of paper that's out there. So there should be this backwind as people come back into that market. The lack of new issuance will actually create a bid supporting that market. So it's not as big as cause concern as it was last year.
That's helpful. Catherine, the performance of mega cap growth stocks in the first quarter, what supported that outperformance?
Yeah, I think we had a slide that touched on this and the outperformance of a group of mega cap technology stocks that really drove the S&P 500 higher. I think with the volatility that arose, especially in March with the banking crisis, investors really sought the perceived safety of these mega cap technology names, especially as we mentioned, sort of Apple and Microsoft. And this was even more pronounced in sort of the Russell 1000 Growth Index, where these Apple and Microsoft compose almost 24% of that index. And that index rose 14% during the quarter, almost half of that in March. And just thinking about what we presented at the last webinar with small cap stocks and how small cap stocks tend to outperform sort of following peak inflation and a down year that we saw in 2022. So sort of an interesting dynamic, I think, largely because of the banking crisis in March that sort of saw small caps underperform. But with those valuations attractive, it'll be interesting to see, and maybe the interest rate environment normalizing, interesting to see what small caps can potentially do moving forward relatively.
Last question, Brad, I'm going to throw this to you about rising SOFR rates and how rising SOFR rates impacted business cash flows.
Yeah, absolutely. It's a good question too, and it's a cause for concern for a lot of different companies right now, because if they are on a floating basis, the costs have gone up, and with that, the interest coverage ratios have gone down. It's something that continues to be watched closely. I think there will just be a greater renewed focus on companies that are resilient, continue to raise prices and fortify their balance sheet for the long term. But it's definitely something that we're keeping on a close eye on when it comes to the private equity and private credit side of the business.
Thanks. And that really marks the end of the questions we have. It's coming up on 2 o'clock Central, 3 o'clock in the East. We promised you 1 hour of content. We've hit that almost precisely. So we'll stop here. Want to thank all of you for joining us today. We hope this has been a good use of your time. Again, these are designed for you, our clients, our listeners. We hope it's been insightful and giving you something to think about, not only about what happened, but more importantly, what's coming for the rest of the year. If you have further questions, there is an email address shown here, research5@marquetteassociates.com. Please feel free to reach out via that email address, or for those of you who've worked with any of us in the past or with your consultant, we're happy to answer any questions you have. So thank you. Have a great rest of the day. We'll see you next quarter.